For majority of us, the last week in the stock market has been absolutely brutal. But a lot of people see the portfolios going down, seeing the balances going down. But also on the flip side, you could also see this as a perfect opportunity to buy the dip when there is a market sell-off. It does give you the ability to buy ETFs at a discount, which is exactly what we're going to be looking at. And a couple of these, and one I definitely want to be covering in here with the ETFs, because when you start looking at the market decline, now the first part, bull market has been driven mainly by tech stocks. So when you think of those big tech stocks, the big artificial intelligence, the NVIDIAs that's been driving it, when you look at Microsoft, when you look at Apple, when you look at Google, this is a really, really big, when you start looking at price to earnings ratios, they were getting monster. I mean, they have been talks about multiple $3 trillion companies that are just kind of blooming because of AI with super high valuations and really disappointing earnings. When you look at the companies themselves, we've seen Tesla actually do this a couple years ago, where the price to earnings was very, very high. And honestly, when you start breaking it down, they are a tech company, but they're also an automotive company, kind of combining the two. But when it comes down to selling vehicles, selling cars, that's exactly what they wanted to do. And unfortunately for Tesla, they were throwing up some very disappointing earnings. Now, of course, when you start looking at the super poor jobs report, that is another one that you really have to think. 114,000 new jobs, which is 35% below what the economists were expecting. So really the expectations were pretty high where the jobs report has been coming on, and it was way lower than they thought. Unemployment rate hit 4.3%, but this is the highest level since October 21. However, you have to really take that with a grain of salt because this is by design. This is why the interest rates are higher. That's why the prices are higher. That's why the housing market is higher, is essentially the Federal Reserve is taking away a lot of the buying power of Americans, meaning that, of course, unemployment is going to go up. Companies to borrow money or actually operate are a lot more expensive. And of course, that is reflected in the jobs report. And this might be the absolute token that Jerome Powell needed to go ahead and start lowering those rates. And some people are even talking today that it could be 0.5%. And the final one, the third one, the Bank of Japan raised interest rates, which was the first time in 17 years. That's right, guys. If you think of America and think of our markets, 17 years, a lot of things have changed over the last 17 years. However, the Bank of Japan have left it super, super low. And of course, a lot of people have been doing what is called carry trading. So they were going over and they were borrowing money in Japan and they were investing that money in the US markets. Well, as soon as interest rates go up, as soon as the value of the yen goes up, all of those people started unwinding all of these carry trades that they were doing, and of course had to pull the money from somewhere, and it did leave the market. But now let's take a look at the possible Vanguards that are really good to buy, that have a lot more stability when the market is the fluctuation. Now, of course, lower interest rates are going to be super positive when it comes to real estate investment trusts, which are REITs. This is focused on real estate investing, and looking at the Vanguard Real Estate ETF is a really good option because, of course, when you start thinking of real estate, there's also going to be and always going to be a need when it comes to bigger picture housing. If they're doing individual homes, if they're doing single family homes, a lot of places we have seen have been doing condos that are only rental condos. We've seen them building entire subdivisions that are just rental subdivisions in their entirety, but there's also a whole commercial side of it. So when you're thinking on the commercial side, when you start looking at bigger companies, Walmart has a building. If they don't own it, they have to rent it from somewhere. But when you start looking at commercial real estate, even looking at restaurants, majority of those are rented spaces that kind of can be run through larger companies that manage these REITs. Now, in addition, they do have the industrial side, which are the big manufacturing plants, which again, a lot of companies don't technically own those buildings. Those buildings can be rented and owned in their, essentially the size of the buildings are massive. But if they are rented, they're essentially paying income or paying rent to whoever does own that building. Now, of course, this is also a big time when a lot of people are talking about small cap stocks. When the large tech companies were just dominating the S&P 500, a lot of the small caps were just getting pummeled or they weren't seeing the growth. Now, of course, the Vanguard Small Cap Index Fund ETF and the Value Fund ETF are two that you can look at. Index Fund, of course, is weight based on how big the company is. Yes, that's correct. The small cap, the index is the index of the small caps. The value one is equal across the entire index. So it's two different ETF portfolios that are built different. Fundamentally, they hold the exact same assets, but they do have a different percentage that is given out of there. And of course, as rates decline, and this is one that I want to talk about, is the bond market. This is a conversation that we've had quite a few times about the bond market, and the Vanguard Total Bond Market Index ETF is a good choice for investors. And if you've seen the one that I follow, and I always follow, Warren Buffett put over $200 billion into Treasury or T-bills, the Treasury bills today. He now owns more Treasury bills than the Federal Reserve, which technically, from my understanding, the Federal Reserve shouldn't be holding or shouldn't be really sitting on that many T-bills or have T-bills at all. The point of those Treasury bonds is to sell them to raise money for the country. That is how we kind of debt finance the country, which is kind of crazy. But the best choice that they go through, and this is an article over on MSN.com, is the Vanguard Long-Term Bond ETF, or the BLV. Now, of course, with the stock market pulling back a little bit, the bond in the ETFs rise. Why is that? Bonds are a safe haven for investors. So if you're looking at market volatility, if the market starts to take a big dip, these people are selling, the money is moving, which is exactly 100% what Warren Buffett did. He anticipated the market moving, almost like he has a crystal ball or something, but he anticipated the market pulling back with the tech being so high. He put it all into bonds. Now the bonds have went up. It didn't say exactly how, and it said how much he put into bonds, but it didn't say specifically what term he bought. So when you start looking at T-bills, they do, I believe it was 4 weeks to 52 weeks, depending on the bond that you are buying. Now, of course, long-term bonds usually perform better than short-term bonds or intermediate bonds because, of course, when interest rates decline, the bond has a bigger value. So a lot of people that are buying the longer-term bonds at a higher amount. So essentially, if you buy a bond, let's say today at 5%, all of a sudden in the next year, the 10-year bond is now at 2%. If you still have that 10-year bond at that 5%, the value of that is much, much higher. Now, when you start looking at the Vanguard Long-Term Bond ETF, it holds 3,901 bonds with the average duration of 13.7 years. And that's right, half of those bonds, 48%, are government bonds. So it is holding the view, really the safest bonds as we know them, because the bonds are issued by the government. Companies and corporations buy the bonds to get the return from the government. That is the same reason why other countries invest in the United States bonds, is essentially, again, kind of that debt financing piece, which I know Dave Ramsey would lose it because, of course, we don't want to deal anything with debt. Yet we're, I believe, 34, maybe $35 trillion in debt. And of course, when it comes to a very low expense ratio, most of the bonds are running about a 0.83. However, the Vanguard one is a 0.04. So the Vanguard, super, super cheap when you're looking at buying bonds. And if the August job number comes in and improves, it is suspected that the Vanguard small cap is going to be the one that is really going to outperform the bonds. But looking to buy and hold long-term bonds is what they kind of covered in here. So all right, guys, so that is going to do it for today's video. Let me know in the comments what you guys think about the bonds, as well as those small caps that we've talked about before, and I'll catch you in the next video.